Warren Buffett is considered one of the greatest investors of all time. He's amassed a fortune of over $100 billion through his investments in companies like Coca-Cola, American Express, and IBM. But what makes Buffett's investment strategy so successful? In this video, I'll reveal Warren Buffett's 8 simple rules for investing. Investing can be a daunting task for those new to it, but with the right strategies and advice, it can be a powerful tool for achieving financial success. And if you found this video useful, don't forget to subscribe and like. Number 1. The importance of starting early. Starting early is crucial to successful investing, and it's never too early. The power of compound interest means that the earlier you start investing, the more time your money has to grow and the greater the potential returns on your investment. For example, if you start investing $100 per month at the age of 25 and earn an average annual return of 8%, by the time you reach 65, you will have accumulated over $344,000. On the other hand, if you wait until age 35 to start investing, you would only accumulate just over $146,000 by age 65 even if you invest the same amount each month. That's a difference of $198,000 just because you started 10 years later. By starting early and giving your money time to grow and compound, you can make a significant impact on your financial future. Number 2. The importance of investing in what you know. Investing in what you know is a key principle that Warren Buffett has followed throughout his career. By thoroughly researching companies and industries before making any decisions, he can make informed investments that align with his knowledge and expertise. Through this rule, he tells investors to focus on protecting their investment by choosing companies and products that they have in-depth knowledge of. While you may find companies or projects that look extremely lucrative, it is not wise to invest in them if you do not fully understand what they seek to accomplish. This approach is important because it allows you to make informed decisions and avoid taking unnecessary risks. Number 3. Don't anticipate the market. Warren Buffett advises investors to focus on the long term and to avoid trying to time the market. He thinks that timing the market is impossible and that investors should focus on investing in companies with strong fundamentals. Buffett recommends that investors buy good businesses at reasonable prices and hold them for the long term. He believes that this approach can lead to significant gains over time and can help investors avoid the pitfalls of short-term thinking. Number 4. Be fearful when others are greedy and be greedy when others are fearful. Buffett recommends that you avoid following the herd when it comes to making investment decisions. To become a successful investor, you need to rely on your own experience in the market. What Buffett is trying to say here is that when a lot of investors think positively about a particular stock, the prices would inflate. If you purchase such a stock, you would end up overpaying and not seeing equivalent returns. This goes back to the idea of value investing, picking stocks with high intrinsic value that are trading at a lower price at the moment. It is important to note here that you shouldn't try to be different for the sake of being different, but should just go with your gut instead of following along with what others are doing. Number 5. Diversify your portfolio. Warren Buffett recommends that investors diversify their portfolio across different asset classes. He thinks that diversification can help investors minimize risk and maximize returns. Buffett advises investors to spread their investments across different industries, geographies, and asset classes. He thinks that by diversifying their portfolio, investors can avoid overexposure to any one industry or market. Number 6. Never invest on borrowed money. Buffett is strongly against jumping into the investment space if you do not have enough money to do so. He says that it is insane to risk what you have and need for something you don't really need. There may be times when you see a stock doing so well that borrowing and investing in it may seem like the right thing to do. However, you must remember that every stock purchase involves risk. Even though a stock might be doing well right now, its value can come crashing down and land you in debt if you buy it on borrowed money. Besides, if you buy stock on borrowed money, your focus would be on returning the money rather than creating a long-term strategy of generating the most returns. Number 7. Focus on value. Warren Buffett is known for his value investing approach, which involves investing in undervalued companies that have strong fundamentals. Otherwise, value investing is the practice of buying stocks that are undervalued by the market, with the expectation that their value will eventually be recognized by investors and the stock price will rise. He believes that investing in companies that are trading below their intrinsic value can lead to significant returns over time. Buffett advises investors to focus on a company's long-term prospects, rather than short-term market fluctuations. By investing in companies with strong fundamentals, investors can avoid market volatility and enjoy long-term gains. Number 8. Be patient. Investing is a long-term game and it takes time for your investments to pay off. For example, when Buffett invested in See's Candies, it took several years for the company's profits to grow and for its stock price to reflect its true value. Warren Buffett is a long-term investor who believes in holding onto his investments for years or even decades. If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes, he says. He advises investors to take a similar approach and avoid being swayed by short-term market fluctuations. Buffett believes that the stock market can be irrational in the short term, but it ultimately reflects the long-term value of a company. He advises investors to focus on a company's long-term prospects, rather than its short-term market performance. So there you have it, Warren Buffett's 10 simple rules of investing. Now that you know them, you need to put them into practice to become a good investor. Thanks for watching and don't forget to subscribe to our channel for more useful tips and insights.